All right. Kate Rogers has CMG. That's Chipotle, of course. I see a rev miss. You can give us the details, though. What's going on?
Yeah. Hey, Scott. So here's what we're looking at for Chipotle. Slightly lighter than expected revenues, as you said, at $2.2 billion versus estimates of $2.24 billion. Comps increasing 10.1%, very high, but also a bit lower than expected. EPS coming in at $9.30 for the quarter. Analysts were looking for $9.04. The EPS figure excludes a few items in addition to a $10 million investment gain, so it's unclear if that number is comparable. It's in-restaurant sales up 35.9%. Digital sales were 39% of its food and beverage revenue, so still a very high number. In terms of guidance, it sees Q3 comps up mid to high single digits. That compares to 7% gain estimated by analysts. CEO Brian Niccol will join us tomorrow in the 10 a.m. hour of Squawk on the Street for much more. That's first on CNBC, and as you can see, the stock is higher, just under 7% right now. Back over to you.
All right, good stuff. Kate Rogers, thank you very much. Look forward to that interview. We've got a guy who owns the stock right next to me, and Joe, who bought it back recently.
So many places we could go right here. Sustaining margins was important for Chipotle. That's exactly what they've been able to execute on here, even though some of the numbers look light. I think that's some of the reasoning why you're seeing the response that you are. Clearly, they've had pressure as it relates to labor costs, ingredients. That's been a challenge, but they've been able to offset it. They've raised prices. They've raised prices significantly, but yet they're still cheaper than a Shake Shack, a Qdoba, or Moe's. So it's digital that's benefiting, it's marketing that's benefiting in all of them, and management really is executing better than anyone else in the industry. That's why I own the name.
Got to be in the right place as it relates to the consumer. Haven't we learned our lesson that over the last 24 hours?
Yeah, I think there's going to be a lot of dispersion in the consumer. You know, I think people were short this thing into the print, too, so maybe you're getting some quick covering here on, getting the squeeze out, up 7%. But I think, you're going to see more dispersion going forward in these consumer names.
Look, it's part of the issue is what you have relative to what people want. But the fact of the matter is execution counts for a lot, too. And if you're able to execute in an environment where everybody, no matter what business you're in, is dealing with exorbitant inflation, you're going to do better.
Yeah.
I bring that up because if you try and do too much of a read-through, say, from a Walmart to an X, a Snap to an X, you better be careful because they're not apples-to-apples comparisons. Everybody has inflation. Some are dealing with it better than others. Sure, the mix of product you have or a Chipotle relative to another fast food or fast casual restaurant may be different, but it's hard to do a straight read-through in this kind of market, Joe. It really is with this environment.
It is, but yet the market did a lot of that today, certainly in the case of Amazon, which right now there's just negativity prevailing throughout. So we'll see what Amazon ultimately is going to deliver. I'm not that encouraged by it at all. But
it's too many hundreds of billions of revenue for them not to be impacted at some level.
There are idiosyncratic stories right now that you could find within the market. And I'll tell you, reported Visa earnings, that's absolutely an idiosyncratic story when you're talking about payments for both Visa and MasterCard. It's compelling, and it's something that's investable in terms of ownership.